In this video, traders are going to look at a little trick with support and resistance that can stop you getting caught out by breakouts when you're actually trying to fade the move. Stick around. Hey guys, a very warm welcome to you. All right, so support and resistance, right? We know the score, we draw our lines on, we put our levels on, and very often want to initiate a trade that's bouncing off that support or bouncing off that resistance, approaching from the high side for support, approaching from the low side for resistance. But obviously the biggest nemesis, if you like, for trading that way is that you end up getting caught in a breakout, right? You end up selling resistance and ends up pushing on. And so there's an extra way, or extra kind of additional filter, if you like, that you can add into your trading under certain conditions that actually might help you stop getting caught in these breakouts. Let's go take a look at the screen. I've got a gold chart for you. It's an hourly gold chart, and we'll have a look at another one as well if we have time. But this is a really good example, right, guys, of how you can kind of align yourself with your thesis of a mean reversion thesis, i.e. selling at resistance and buying at support, but trying to minimize the times when you get caught in a breakout. Let's go check out the screen. All right, guys, so I've got a gold chart up for you here, and it's actually an hourly chart of gold. Let's try and move this out of the way so we can see. So really the idea is, right, we come up to support and resistance, and we'll draw our lines on as normal. So we would, and let me just clear some of these lines off so we're kind of looking at it as if we were looking at it from a clinical brand new perspective. We draw on our support and resistance line, so we'd have our kind of resistance here, for example, and that wouldn't be an unusual place to have our resistance, right? We've got, you know, a decent level of, we've got a decent, it's gone yellow, let's put it back to normal. I've had it on a black screen, that's why I've got different color here. Let's put it on a thick black, that's easier for us to see. So we've got a resistance here, and we come up to the resistance, and very often we want to fade the resistance, right? And yes, we get away with it a lot of the time, and there's opportunity there. But very often we're going to get caught in something like this. Okay, so we've got our black line. Let's just make it solid so we can see it a bit better. I don't know why I've got it dashed on. I do know why I've got it dashed on, because I often use those for alert lines. Okay, so, you know, let's look at the scenario here, right? We've got let's not go into the details of drawing support and resistance at this moment. Let's just have a look and say, okay, we've got this as a reasonable level. Yes, we could go one level higher here, perhaps, and perhaps we should, but we've got this as a several touch point here, and we're coming up to the price here. So we want to try to stop ourselves, A, getting caught in a breakout, or B, selling it prematurely when really it might just fake through and come back. Because what's the decision making process we've got is we sell at support, we sell at resistance, and we have a stop a little bit above. Now if we're selling early on in the move, let's say we're selling here, let's say we're on this part of the chart now and we're selling here, where do we put our stop? Well, we might want to put our stop here, but in reality it's not a bad place to initiate a trade, and very often if it's going to fake out, it's going to do that. So we're kind of caught in a bit of a dilemma. Do we sell it at the resistance and kind of have a reasonably wide stop to allow for a bit of a fake through? But then if we're doing that, the risk reward ratio isn't that great. So one thing we can do is we can start to trade it from a perspective of, okay, I'm only going to trade it if the market comes back through the resistance. So in this example, let's say we've got our resistance here. I'm just going to draw kind of freehand. The market comes through. We're not selling at this point. We're waiting for it to come back through, and then we're selling at this point, and we're using that as our stop if possible. So rather than sitting on the front end of the move, we're looking at the back end of the move. Now, when it comes and it just kisses the market, it kisses the level, are we going to miss it? Yes, we are. We're not going to be involved in that. However, you know, if we get a push through that comes back, then we're short of the resistance, then we've got our stop in, then we can take, you know, kind of multiple hour, however many, 1 or 2 day worth of deal on that, and in this case, you know, a reasonable little scalp trade if we're looking for a day trade. Same with this, we don't take it here on this part of the move, so we're not caught in this, we're not getting stopped out, we're waiting for it to come back through, and then we're taking it here. Now yes, this took some time to roll over and give you the profit, but you know, who knows where it's going to go now. If you're a longer term trader, maybe your vision is if it comes down to 1400. The point is, you're not stuck from 1425 all the way up to 1450, $25 worth of are paying, or $25 worth of stop, you're in it as it comes down, and it becomes a different trade for you. So yes, maybe if you're looking for a longer term move, you can have a stop up there and you're looking for multiples of that moving to the downside, fine. But what it allows you to do is it allows you to not get caught up and frame the trade a lot easier. You know, if we go back onto our cursor here and we kind of scroll and we flip it on the other direction and we say, okay, what about our buying at support? So let's say we had our support level here, very short-term support level. Well, the beauty of that, again, guys, is that we're not getting involved in stuff that doesn't suit us. So we're not getting involved here, we're buying as it comes back through the support. We're not getting involved here, we're buying as it comes back through the support. Yes, maybe it's a stop out, but here again, you're not getting involved you're getting involved as it comes back through the support, and that's the difference. It's waiting for it to come back through a key level. I'm going to very quickly show you Euro US dollar because that's very similar. Now, you've also got to make sure that the chart conditions are the same conditions that you're expecting, i.e. there's no point in trying to force something onto the market that isn't the right conditions. If it's a trending market, then this isn't going to work for you. So look at the Euro US dollar, for example. Very kind of range bound, but yet drifting to the downside. And if you were playing that range, it becomes more prudent to use that strategy of, okay, here's my support 1.13, right? Yes, you may miss some of these things, but you're getting this is on a higher time frame. I'm buying when it comes back up. I'm not getting caught out on this fake through. I'm buying as it comes back up. I'm not getting caught out on this fake through. I'm buying the next day it comes back up. I'm buying this wick. I'm buying this wick. I'm buying the cluster as it comes back through. And yes, probably theoretically you're going to get stopped on this because you're probably buying it here and then you're getting stopped there. But the stop isn't too bad. Here you're buying as it comes back through. You've not been involved in any of this participation. This is a different trade, different trade, different trade. Now it's suddenly become resistance, and maybe you want to treat it the same way. You're not waiting for the first kiss, you're waiting for it to come back through. Not the first kiss, happens to be a week later, it comes back through. So it's a different way of structuring your support and resistance trade. It's not always going to work, it's not always the best way of approaching things, but it's a different way of looking at it. Rather than going, well, I've got to make my decision now. It's hit my support level, it's hit my resistance level, what should I do? Well, say, okay, you know what, I'll wait for it to go through and come back through afterwards on day 2, day 3, hour 4, whatever it may be. And then you can frame the trade of the extension it's gone to, and maybe you might have the odds in your favor that it's tried. Supply and demand imbalance hasn't been in the favor of supply or demand depending on which way it's going through, and it's tilting back the other way. So yes, you're trading the back end of the move, and you're going to miss a few, but it might be a little bit easier to do, a little bit better in terms of how you can manage the risk. All right, guys, I hope that's helped. I'll see you in the next one. Take care. Bye-bye.